the fees are too damn high on those products. And so actually what's happening is you're taking low cost liquid exposures and things like credit or equity, and you're replacing it with high cost illiquid exposures, and investors don't need that. And so that's where what I'd say is alternative strategies come in. That's different. There's alternative asset classes and alternative strategies. And alternative strategies are very different because what they do is they provide the opportunity for actual diversification. And they do that predominantly through being able to be long and short assets.
Let's go boom.
Hello, everyone, and welcome to another episode of What's the Alternative, the show where we dive deep into the details of alternative investments. We have somebody who is more on TV talking about alts than even me. They call me the queen of alts. I don't know. Is he the king of alts? Maybe. We have Bob Elliott with us, the CEO, founder, and also the chief investment officer at Unlimited Funds. Probably the only person in the business that has been working in the hedge fund world and the alts world longer than me. And so I'm super excited to have Bob here. Unlimited Funds has their flagship fund, which is HFND, which just hit 3-year track record, which is very impressive, and has launched some new products. So we'll get into all of that. But I want to start, Bob, with a little bit about you. What's your background? How'd you get into alts? What made you so passionate about it?
Hey, thanks so much for having me. It's great to do a podcast. I feel like we bump into each other kind of everywhere.
Yes.
It's like all the alts nerds get together in various locations. We sort of go with each other and catch up on the alts market. So it's fun to join the podcast that you're doing. My background, for folks who don't know, I spent the majority of my career in the hedge fund space at the world's largest hedge fund, Bridgewater Associates. And while I was there, I was responsible for creating investment strategies that were proprietary across the whole range of different asset classes. I was on the investment committee. I wrote the daily research report, and really was part of the small handful of investors that helped take it from being a challenger in the industry to an incumbent. And the interesting thing is, through that process, I learned. I basically came to two conclusions that everyone in the industry knows, but no one will ever mention. Those two things are, one, all of our hard work, we weren't necessarily any better than any of our other institutional peers. Meaning, basically everyone in the institutional community, we're all about the same. Mm-hmm. Some years some win, some years the others win, but no one is meaningfully different from the rest. And number two, I was being paid too much, which no hedge fund manager is going to say.
No one's ever going to say that.
No hedge fund manager is going to say that. But it's the reality, because the problem in the hedge fund business is that while hedge funds generate plenty of alpha over time, managers basically take all that alpha for themselves in fees, and they leave investors, even institutional investors, not that much better off than they could do without the hedge funds in their portfolio. And so those two realities, that I'm not better than the peers and that I'm getting paid too much, sort of inspired me to say, hey, look, I have to do hedge funds differently. All right. I'm going to take a path that's very different from the rest of my peers that are still out there hanging their 2 and 20 shingle. And instead, what I'm going to do is I'm going to figure out how to bring diversified low-cost indexing, which has obviously totally changed stock and bond investing, and figure out a way to bring it to hedge fund investing. Because if you can diversify your managers to improve return consistency and you can cut the fees, well, then we have a very different story about the value that hedge funds bring to your portfolio.
Yeah, I agree 100% with everything you just said. I was working for a hedge fund at Russell during the financial crisis, actually prior to the financial crisis, like going into it. And it was in 2007, and I'm probably not going to tell you anything you don't already know, but for our listeners, here's a little history lesson. 2007 is when the SEC changed some of the restrictions of the 40 Act that made it possible for the proliferation of liquid alternatives. At that time, mostly through mutual funds, and the point at which it happened. Anybody who's been in the business for a while will remember it. All of a sudden, every asset manager on earth launched one 2020 and one 30-30 funds, or 125-25 funds, or something to that extent. And it was made possible because of these changes. And then every hedge fund sponsor was like, oh man, I can get into this market. I'm going to put a mutual fund out there. So not necessarily low cost, but didn't know how to market it and was completely unfamiliar with distributing to the channel. So we saw this huge amount of new product come to market at exactly the wrong time. And then I think at its height, because I actually have this in a graph, there was like 1,500 funds that were alternative mutual funds, and that fell down to like a couple hundred after 3 or 4 years. And so that actually speaks to what I want to get into next, which is the difficulty of having these products in the liquid alt space. And it's not because they're not good products, is there's a couple of problems. There's an education gap. Nobody really knows how to use them. One of the things I'm really passionate about is trying to teach advisors how to like put the building blocks together, because they know they got to do it in equities and they know they got to do it in fixed income, but I don't think they necessarily realize that you got to do it in alts too. It's not a one-stop shop. You got to think about how do you put a couple of alts funds together in the same way you would do it complementary in equities or fixed income to get the maximum benefit. And that's what I find so interesting about unlimited funds launching additional product, because that makes it easier to do that. And as you and I were discussing before we jumped on, Bonrian has partnered with Wisdom Tree to also do that in open architecture form. We are actually included HFND in that product. And so, there's that part. And then massive disservice is being done to advisors and categorizations of these products. I always pick on Morningstar, and I almost feel bad because there are some great, really awesome folks at Morningstar, and I know that they're trying, but I feel like they should talk to HFR and like learn, because they're throwing things into categories that are just a mishmash. Like large cap growth is really well defined, but like options based is like if you use options you're in the category, which is like not helpful. And we were talking about HFND, it's multi-strat, but is it really multi-strat? And like there's a macro category, but macro funds can be in tactical allocation, and it's just not helpful for advisors to be able to find good products. So a lot of managers like yourself have trouble raising assets, and then you find that the people who are raising assets aren't really doing alts, and they just know how to package the story, but it's not actually a product that should be considered in a diversified alt portfolio. So let's dive into that. Let's dive into kind of what you see as a sponsor of a lot of these products, and how you kind of try to overcome that with your educational resources and things of that nature.
Yeah, I mean, I think when it comes to the alts world, I think a lot of the focus over the course of the last, 5 years, let's say post COVID, has been really about finding and getting clients into alternative asset classes. And obviously there's been a nice push from, your private credit folks, your private equity folks, et cetera, real estate, to kind of
But
create
those are alts because of structure, not alts
right,
because of
right.
diversification. And
That's
I
right.
will
That's right.
die on that hill, because private equity is
And
equity and private credit is fixed income.
that
And that's where
that
they
that is
belong.
that's exactly right. And I will be next to you on that hill, continuing to shoot.
Yes. We'll be in the rabbit hole together.
We'll be in the rabbit hole together. And I think that's done. And I totally agree with you. Those are basically just, those are just long only positions, long only exposures dressed up with like a little accounting drag. That's basically what it is.
As
It's
Cliff
not
Asness calls it, volatility laundering. But go
right.
on.
Exactly. And so the whole world's been focused on that. And I think one of the challenges in the world is that those strategies provide no diversification benefit to your portfolio. None. If anything, they're detrimental to your portfolio because the fees are too damn high on those products. And so actually what's happening is you're taking low cost liquid exposures and things like credit or equity, and you're replacing it with high cost illiquid exposures, and investors don't need that. And so that's where what I'd say is alternative strategies come in. That's different. There's alternative asset classes and alternative strategies. And alternative strategies are very different because what they do is they provide the opportunity for actual diversification. And they do that predominantly through being able to be long and short assets at various points in time. And so when we talk to advisors, almost always the first thing I put up is a chart basically saying, of all the assets in the world, what are the most diversifying assets that you can find that you can include in your portfolio?
Mhm.
And when you look at that, there's basically three assets that are the most diversifying to a standard 60/40 portfolio. It's commodities, diversified commodities,
Mhm.
gold, which people are finally learning a little bit about recently. And then the last is diversified hedge fund strategies at low cost. So something like global macro is basically the best bang for the buck diversifier you can have in your portfolio. And it's basically why I started Unlimited. I said, look, there's three things that diversify 60/40 portfolios. You can go out and buy gold, a lot of options for that. You can go out and buy commodities, great options for that. There's no good options out there for diversified hedge fund strategies at low cost. And so that's what I'm going to focus on, because those can be meaningfully complementary to clients' portfolios. And when they look at that, and they look at that sort of theoretically and then look at it practically, like the through time picture of how those strategies have performed relative to traditional portfolios, almost every time I see sort of like a light bulb go off and they say, oh, wow, these can actually provide diversification benefits to my portfolio. This really is what I should be focusing on, and not those alternative asset classes, but alternative asset strategies.
Absolutely. I wrote the curriculum for the Kaya Fundamentals of Alternatives module on this subject, diversifying versus non-diversifying alternatives, and like thinking about how you do portfolio construction from that. I did that about 2 years ago. Me, Phil Huber, and a couple other names that you would be familiar with were asked by Kaya to write those modules, and you will see my face in the module if you take the course, because they actually had me video one of the modules. So apologies, it's not as if you don't see me everywhere as it stands today. But I'd love to get your thoughts on how you've been able to do it low cost. And the other thing is, have you run into this? Because I know our partners at AGF have to do an educational lift on how the SEC makes you report your fee versus what your actual fee is because of the shorting aspect. And I try to explain that there's some phantom fee that's added into your expense ratio that's not actually real, and you're being held like you have a higher expense ratio when you're in reality you don't. Does that affect you as well in the strategies that you run?
Yeah, I think one of the challenges is for any alts investors really trying to think about how do you craft a product that delivers those returns, but also fits into the norms of the industry. And I have to be honest, like it took us a little while
Hmm.
to learn all the nooks and crannies of the things that were needed to do this.
Yeah.
And so part of the way that we go through that process, with our strategies, is that we're using predominantly futures exposures
Hmm.
in our underlying strategies, which actually the ETF wrapper is pretty good for that
Yeah.
sort of thing, because you can get a good, you can get medium turnover strategies in an ETF wrapper without a lot of the sort of typical tax effects that you'd get, say, with a traditional LP structure, where you're getting maybe 60/40 tax treatment or K1 ordinary income treatment. You put that into the ETF wrapper and only basically experience having to pay out an ordinary dividend on an annual basis. And so that's pretty efficient. And the futures also are nice because they don't incur. You can basically engage in short positions without incurring the phantom fee costs that the SEC has on borrowing costs.
Yep.
And so that's kind of how we work through that. Futures are also just happen to be beneficial because they're in general the most liquid, efficient way to express positions, directional
Yeah.
positions, and large liquid asset classes. And so that's how we construct these things that has sort of the efficiency of execution and the efficiency of sort of meeting the nuances of the accounting of costs in the industry.
Now, I was on a podcast yesterday talking about synthetic leverage and derivatives as synthetic leverage. You see a lot of that in mutual fund and ETF format because of some of the restrictions on actual leverage in the
Yeah.
40 Act. So using derivatives gets you through that. But one of the problems that arises, and I'm curious if this is something that you look to address when you're talking to folks about this, is that if I were to go to Morningstar, like most advisors will go to Morningstar Lipper, and there's that little box, the one I'm talking about, where it's like it's this much in fixed income, this much in equity, and whatever. Because you're using derivatives, that means that you have margin and you have to have something and as collateral, and it's always treasuries, right? So then when they look at what you actually hold, it looks like you just own a bunch of like treasury bills, which you don't. And because the exposures on Morningstar are looking at like not the exposures or what the views you're being expressed through the fund, but like literally what the fund functionally holds. It looks like you just own a bunch of cash. So, can you talk a little bit about why that is and how an advisor might be able to understand that to get a better understanding of what the actual views being expressed are versus what, a Morningstar or Lipper is going to show? Because I think that can be really confusing.
Yeah, I do. A lot of these platforms were structured and designed when people were investing in individual stocks, right? You're like
Hmm.
a very, large cap value manager or something like that, and
Right.
you're buying 30, boring stocks out of the S&P 500. And so the sort of tech whizzes haven't really caught up with the fact that there are more securities in the world than just single name equities. And so when they look at these products and try and put them into their various platforms, I mean, we have sometimes where some of these platforms will only show cash security positions, meaning they'll
Hmm.
look at they'll pull up our funds, which hold futures predominantly, and an advisor will say, "Why are you holding only cash in your
Right.
portfolio? Like literally only cash in your
Yes,
portfolio?" And you're like, obviously, how are you generating those returns only holding cash? Well, it's not.
exactly.
It's because it doesn't capture the actual positions that we have. And so you sort of have two choices on this. One, you can go to more sophisticated or expensive platforms like Bloomberg does a pretty good job in terms of capturing what's actually in there, or you can go to the funds, the product pages themselves, which I know is not something that people are necessarily inclined to do. But I find when you're working in this world and you want to actually understand what people are doing, go to the product pages. Every single ETF has to publish its positions in all the securities it holds every day with a 1 day lag. And when you click on that position, and I do this all the time with, let's say friendly competitive products as well, to try and understand what's going on with them,
Mhm.
you will get what you want, what you need in order to understand what they're doing. So we have by QSIP level understanding of all the different positions in there. And so that's mostly what we guide people to do. We also have I've found it useful, and this is kind of for any of the issuers that are listening to this. I've also found really helpful just communicating to people, your prospects and your clients on a regular basis, just a qualitative overlay in terms of like, here are the positions, here's the basic exposures of the fund. We can get into the nuts and bolts, but like by and large, we're short the dollar and long gold. Like that is
Exactly.
and that's the sort of conversation that if you bring that and particularly proactively push it to advisors, they really appreciate it because they can go talk to their clients like, why is the global macro strategy doing well? Okay, well, it's because it's long gold and short the dollar, like as a simple example.
Mhm.
And that's very easy. So just helping do a little bit of the lifting for the advisors in
Right.
terms of their ability to communicate with their clients goes a long way.
Yeah, no, I completely agree with that. I think that, as you stated, um, good sponsors will do that. Um, I do a show for ETF Guide called ETF Battles. Usually once a month, I do it for them, for Ron and the team, and they love to put me on when they have anything that is in the flavor of alts, even if it's not truly an alt. If it has a flavor that might be a little complex, like we did some levered ETFs, like two times
Mm.
S&P levered kind of stuff the other day. And one of the things I said is a good sponsor And I would call Unlimited Funds a good sponsor because I've gone to your website and I've seen your insights and I've read your information and I see you on TV and I see you at
I
conferences.
appreciate
You
that.
and I feel oftentimes you and I are doing like the Lord's work because we're like trying to be honest and out there. But there's so many others that are just trying to push product and like not being honest about it. I always say sometimes you have to look a little harder. Sometimes you got to open that prospectus to see what's actually going on there and how people are gaining exposures because they're not always transparent about it on their
Mm,
website. And you think it's one thing, and then you go into the prospectus and you're like, oh my God, that's not at all what I thought it was. I think with long short, that's important. There's long short equity, which I think Morningstar has that as a category, but then I think they also have like a hedged equity category. I might be
mhm.
wrong. It might have been that it was once called long short equity and then they changed it to hedged equity. I can't remember. Either way, those are two different things. Long short equity means you are long and short. Hedged means you are maybe expressing your short view through options based product.
Right.
And those are different things. And sometimes you need to go into the prospectus to decide and figure out which one of those things they're doing. I would argue you can just look at the expense ratio and it'll tell you right away because if it's really high, it's probably like actually shorting stocks. And then if you go into the prospectus, you'll find out what the actual cost of the fund is. But it gets to that point where you're talking about that phantom margin cost and the
Mm.
phantom dividend payment cost that they make you put back into the expense ratio. But I will say that sometimes not every sponsor does a great job of explaining those things through their materials, which makes it hard for advisors. So we always try to help advisors through that. But when we can work with sponsors, like say an unlimited funds, that does that with a consistent basis so that it makes it really easy for the advisor to set return expectations. Number one problem I find in alternatives, at the end of the day, all of the problems could be completely avoided if sponsors made sure that advisors understood the return expectations of a product. You will never ever get fired for poor performance if the person understood when you will do well, when you will do poorly, and then aren't surprised when those things happen in those conditions. And then because it also makes it easier for them to talk about it because then they don't have to call you and be like, what's going on? They just know because you told them and you're putting out consistent information. And global macro is really interesting. Global macro and managed futures get thrown together a lot, but they're not one and the
Yeah.
same. They what's the word? Um they're not repeating, but they're rhyming. They are similar in what they offer from a risk reward perspective and tend when they outperform. But the one thing global macro does that is not true for managed futures is you can have a global macro fund that consistently does okay regardless of market conditions because it's a little different. So, can you talk to us about what is global macro? How do you evaluate a global macro manager? And then to what you were just talking about, when you are reviewing, the monthly updates from a global macro manager, what should you expect for them to be communicating with you to understand what they're doing?
Yeah, I mean, I think you're totally right. And if anything, actually, some of the categorizations actually jam managed futures and global macro together. And the reason why they do that is managed future strategies and global macro strategies often trade the same opportunity set by and large, meaning
Mhm.
they'll trade global currencies, commodities, fixed income, credit, equity indices, things like that. But the way that the two strategies work are pretty different. And so most managed future strategies are predominantly focused on using price information to generate views on markets. Um, Often trend following, although not exclusively trend following the recent price action. That's super beneficial because there is there's a real discipline of following price action that can be important. That generates good returns, particularly in down market environments and
Mhm.
defensive periods where you might not have the innate discipline to follow that. Global macro, the way I like to think about global macro is um, it's related to manage futures from the opportunity set, but the perspective that managers take on the markets is different. They're predominantly looking at conditions where what is priced into various asset markets is inconsistent with projected views of what will happen either with macroeconomic, the macroeconomy, or with policy efforts. And so, the simplest story there is, say the macroeconomy is giving some indication that monetary policy should be less easy than it is, and the market isn't pricing that in. Those managers will take advantage of that by putting on positions, whether it be in short rates or in bonds.
Mm-hmm.
Whereas the managed futures folks, whatever the price trend has been, that's what they're going to follow, whether it is consistent with the macroeconomic conditions or inconsistent with it. And so that's kind of the difference. I think part of the benefit of the global macro side of things is, as you mentioned, in some ways it's a bit more of what I call an all-weather alpha, poking a little bit of fun at the old shop.
Yeah.
And what I mean by that is, because of the nature of that approach, what it means is that those managers can generate positive returns during positive asset market environments. I mean, for instance, recently global macro managers have done extraordinarily well. It's been one of the best periods for global macro in some time. But they can also generate positive returns in negative or weak asset market environments. For instance, probably in the last 10 years, the other best environment for global macro was 2022, when assets were going down,
Mm-hmm.
right? And so you kind of, because in both cases there were those mispricings, like for instance recently in the dollar or in gold, or back then it was in stocks and bonds. And so the ability to sort of flexibly think about the world, think about the market action, and be able to put those positions on means that global macro can generate a more consistent return than a lot of other alpha strategies that are out there.
Yeah. So I started running alt portfolios just prior to the financial crisis. And 2008, 9, and 10, I was running um, basically a liquid alt model, but mostly with mutual funds at the time. But I was managing it pari passu to a hedge fund model with actual hedge funds. And one of the things that stood out to me is, at the time, there was no global macro offerings in the mutual fund world. There was a lot of CTA stuff. Guggenheim had a bunch of stuff. And then, but there was no global macro. But in the hedge fund world, there was tons of global macro. And the one thing that stood out to me through that period is both my managed futures products and my global macro funds outperformed. But the global macro funds crushed in ways that I can't even begin to fathom through the financial crisis. And then out of the financial crisis, they were able to maintain strength and performance that the managed future funds just weren't. And you mentioned trend following, and I always found this interesting. Clearly, there was a trend coming out of the financial crisis because it was a trend straight up. But managed future strategies do trend follow, but it doesn't always equate to meaning that it would trend follow upside momentum and upside trends as well as they do downside trends. And they tend to almost be perfectly negatively correlated with equity markets, which makes them so hard to own. So having global macro strategies be more available in liquid form is, I think, a good thing, because they do, to your point, start to be more persistent. But can you speak to a little bit about, you did touch on it, but dive a little deeper into why, you will see that almost perfectly negative correlation of managed futures, but not necessarily the same for global macro.
Yeah, well, I think part of the story, the financial crisis is a good example, and I think gives a good case study in terms of the difference in the strategy. So, I love the fact that it's rare that I get to talk to somebody who had lived firsthand through the global financial crisis, and I have to say, those of us who went through that, who are up close to markets, have just like a totally different perspective on how financial markets work and things like that. So, um, and we all learned a lot of lessons there. And I think a good differentiation between both of between managed futures and global macro happens there. If you go back to March of 2009, which is when the Fed basically said that they were going to institute large scale QE in order to turn the economy around.
Mm-hmm.
If you were a managed futures manager, what you'd be doing is sitting at S&P 500 666 and saying, this has been going down a lot. I want to follow that trend and continue to be short. If you're a global macro manager, you say the largest QE that has ever existed in modern financial history is probably a good time to buy. right? And those two things are two totally different perspectives. Now, over time, trend following obviously generates good returns and good diversifying returns because of the discipline that it brings, but it isn't a perfect solution because there are critical policy or macroeconomic turning points that macro managers, I think, in general, are better positioned to take advantage of. And so, I mean, I actually remember sitting at the, I guess, the equivalent of the investment committee at Bridgewater at the time, and we looked at that and we said, "Whoa, everything's changed. The world has changed because of this quantitative easing." It's hard to believe that there was like a time when people didn't really even understand quantitative easing. It wasn't even a thing, and it wasn't
Exactly.
a policy ever pursued before. Like now, it's old hat, but back then it was a huge change in policy, and we said this will mark the bottom. This will be the critical turning point in this cycle, and so we're able to take advantage of that and deliver the results that you described, both in the down and then back in the rebound.
Yeah. I started working in the alt world just before the financial crisis. And whenever I tell the story, when people are like, "How'd you get into alts?" I'm like, it seems weird to a lot of people that I say I became so passionate about alts during the financial crisis because I was like, "Oh my god, I wish my dad could own some of this stuff," because I was seeing like global macro managed futures. And at the same time, like other stuff was actually blowing up and causing the crisis. Like the hedge
Right.
fund I worked for went under because Muni R blew up. And so it's such a weird time to be in the space, but I always felt like hedge funds were the canaries in the coal mine. Like we started to see like liquidity problems with some of our asset-based lending funds in like mid 2007, which was before
Mhm.
everything started crumbling. And it was like, oh my God, something's going on here. And then when you saw that value sell off that August, do you remember this?
Yeah, for sure. Yeah.
We knew and understood that that was a margin call issue with hedge funds having stuff that they had no liquidity in, having to sell their most liquid stuff. Like MLPs were another thing where coming out of the crisis, I was like, well, it's such a no brainer to buy MLPs right now.
Yeah.
And I made a ton of money doing that, but that was like an alt. And for me, it was like, oh my God, this was the point at which I thought, okay, I now am fully converted. I am preaching the gospel of alternative investments. You have changed my life and I will never stop. And that's where it all started for me, was during the financial crisis. You know, um, you talked about a little bit, like, how was that for you? And is that where kind of this idea of like, okay, we can do this better, cheaper, and we can make it better available to other people? Because that was the moment for me that I was like, we need to make this available to the broader investor base, because I feel like there's a cheat code and it should be available to everybody.
Yeah, yeah, and I think for me, when you're in a hedge fund, and this sort of speaks to the overall hedge fund industry, like everyone is trying to prove to whether it be their clients or themselves or the public that they are the master of the universe.
Hmm.
And the interesting thing is any person who's been in an institutional quality hedge fund will have experienced meaningful underperformance relative to their peers for an extended period of time. It's just how it
Yep.
comes. Sometimes you're right, sometimes you're wrong. Alpha is by no means a up and to the right straight line. It
Right.
is a over time up into the right straight line, over time up into the right, but it is aligned with a lot of chop.
Yeah, because you
And
gotta be
so
contrarian to get that big outcome, and at
that
some point in time where being contrarian is painful. There's a book I
And you're
read, and
wrong. You're
I
wrong a
right.
lot. Like,
I
it is hard to believe how wrong you are and how often you are
Yep.
wrong. In order to generate alpha over time, you have to be wrong a lot. And as a result, you will underperform your peers over time. Even though when you look at the hedge fund industry in aggregate, what you see is the aggregate of the managers generate pretty good returns, particularly if you take the fees out. They
Mhm.
generate actually quite good returns over time. It's just that any one manager, they're like volatility around the wisdom of the overall industry. And so that's really when that finally crystallized in my mind, in part thanks to a extended challenging period relative to our peers, I realized, hey, look, the right solution to this is not to try and beat every other institutional hedge fund manager because it is a fool's errand, right? The
Mhm.
best thing to do actually is to diversify across the managers, because over time, what you see is that diversified portfolio of managers, the wisdom of their insights in aggregate, is actually a more consistent outcome than is trying to pick any one individual manager. In some ways, how many people see investing in the S&P 500, like an index fund, is actually better than trying to pick, the 10 stocks that are going to outperform.
Mhm. Absolutely. Um, you talked about low cost passive, but in a way, global macro is never truly passive. So how do you do that approach in a way where you can have a lower fee and have a more persistent and consistent return profile while being kind of like pseudo passive? Because again, you're obviously making bets based on a house view. Um, but how do you kind of how do we do that where it's like active, but you're doing it as best you can in a passive vehicle?
Yeah, I mean, I like to describe what we're doing as alpha indexing. That's
Okay.
probably the best way that the best phrase I've come up with, although I'm all ears for other better phrases for it. What we do is functionally what we've done is we've basically planted a bug in 500 in the 500 largest macro managers investment committees, and understand exactly how they're positioned and what they think is going to happen. And then we just take that understanding and we basically net out what is the net view across the biggest, most liquid markets in the world. And with that understanding, put on those positions through the ETF wrapper, through holding futures, like we talked about. And,
Mhm.
and the way that we do that is very different. A lot of sort of diversified hedge fund strategies, fund to funds, for people who've been around for a while, what they'll do is they'll invest, they'll dabble in this fund, in this fund, in this fund, in this fund. And that in general is, creates a diversified portfolio. The problem is you're paying the managers 2 and 20 in general, and then you got to pay yourself something, and now we got fees on top of fees,
Mhm.
and that's terrible. And so what we did instead is we developed technology that allows us to infer how those managers are positioned by looking at their returns, which we actually get in relatively close to real time. And if we can infer how they're positioned from that return information, we can then understand the positions, the wisdom of the crowd, without having to pay any of them the fees that they typically require to understand how they're positioned. And so what I like to say is I hired 25,000 hedge fund managers who are all running around spending billions of dollars making decisions, and I'm not paying any of them. It's like magic in the sense of I get their insights without paying them. And as a result, what I can do is pass that on to the people who invest in our products, because I don't need to charge 2 and 20, because I'm not paying star portfolio managers big bucks to make the calls that they are. I'm paying
Mhm.
those managers nothing, and we're using technology to look over their shoulder.
So what you just described sounds a little bit like hedge fund replication, which I have when I was at Russell. I was given a task. It was like one of the first things they asked me to do. And I didn't realize it at the time. It was just like a 20 something year old and it was just doing whatever they asked me, building out the model. But it ended up being hedge fund replication. Basically, they said, like, we have these exposures and we're gated at the moment and we need to hedge out these exposures. So
Mm.
can you please take these exposures, put it in a regression model, and then figure out what we need to buy to hedge out, like neutralize these exposures until we can get out of them. But the problem with doing that, like, it was easy for me to do it at the time because we owned those products. So we knew what the performance was in real time and we
Mhm.
knew what they owned in real time. But when you're doing it from like afar, you're using like an HFR benchmark. An HFR, for all the good it is a self-reporting vehicle. It's not like Morningstar, which just pulls the SEC reports, which they have to do all the time. HFR is very much self-reporting. So a lot of managers, when they're doing pretty poorly, don't self-report. And so you have like a bias in the sample that doesn't always reflect like the broader view. It's also at a substantial lag. So your R squared, your adjusted R squared can be off a little. How are you able to do that? Like you said, almost in real time. Like how are you able to get the data? Is there someplace you're looking that others don't, or just your institutional knowledge from having worked in that space? Like, how exactly are you able to do that without having the bias in the sample and the lag in the data?
Yeah. So the great thing is there's been quite the evolution in terms of aggregators of hedge fund performance over the
Hmm.
course, basically back since your HFR days.
Hmm.
Only looking at the HFR, where there's now almost close to a dozen different entities that are gathering hedge fund performance. And you're right that most of the reporting is done is done proactively by the funds themselves, although there's been a real institutionalization in the index construction so that things like poor performers can't really drop out
Hmm.
of the indexes, the way that if you go back 20 years the indexes sort of had some of that issue.
Thank you for
um,
reminding me. It's been almost 20 years since I did this project.
yeah, we've
Come a
got
long way,
plenty of
kid.
experience. and and I think through that process we now have a pretty good, basically all the major funds that
Hmm.
report to one or more of these providers these days. And so
Okay.
we use all of them because essentially you can think about they're all like slightly different samplings of the industry, and we combine them all together in our process to get a good understanding of how managers are positioned. And most of that stuff is the best in class stuff we get a few days into a subsequent month. So we actually have pretty timely understanding of performance. We also have indicative performance data, whether it be weekly or daily, from other sources that maybe are more incomplete, but they are quite indicative of returns, meaning they're highly correlated. They may not be the exact same, but they're highly correlated, and we can use that information to get a very timely sense of how these funds are performing. The second thing that we're doing, so we have pretty good timely sense of how the
Hmm.
managers are performing and pretty broad coverage. The second thing we're doing, which is really important, is instead of going back to sort of the old school regression techniques, which kind of had a challenge because regressions are by definition an average over a period, right? And you have to have enough time frame in the back history to be able to develop those. So, sort of more traditional replications might average the last 36 months, or there's a meaningful product in the market right now that's averaging the returns over the last 10 years.
Hmm.
Like, knowing hedge fund positions over the last 10 years on average is a useless thing
Yeah.
to know. What you want to know is their positions today and how they're changing. And so what we do is we use um, modern machine learning. It's really like a sophisticated Monte Carlo simulation to probabilistically infer today's positions by observing today's outcomes, but in the context of the previous portfolios that describe the previous returns. Because one of the neat things that you realize as an institutional manager is that funds don't instantaneously shift positions. This is really an important concept. Meaning, like, you can't go long stocks to short stocks if you're running $5 billion. I mean, even if
Right.
you're running $1 billion, you can't do it day to day. It's not how it works. You pay too much transactions costs, you get eaten alive on that. And
Hmm.
so what you do is you incrementally change your views over time. And so if you think about it, any one manager and any aggregation manager, say 500 managers, they're incrementally changing their positions over time, which means that there's actually a lot of information value in that path of returns because today's outcomes are a function of today's positions. Today's positions are adjacent to yesterday's positions, and yesterday's positions can be observed through yesterday's returns. And given that there's not that many probabilistic portfolios that are connected to each other, adjacent to each other, that describe today's outcomes and yesterday's outcomes, and then the day before and the day before and the day before. And so what we run is basically a big probabilistic model that basically says, okay, what is the likely positions that they're holding today, given the returns that we're seeing, but also constrained by the fact that that portfolio has to describe recent returns through time. And so it gives us a much more tactical sense of the alpha positioning because we're not averaging the last 3 years or anything like that. What we're doing is solving for the portfolio that's describing the returns today in the context of those past portfolios, but not averaging those past portfolios. And that's allowed us to capture tactical alpha positioning much better than previous efforts at this.
And probably much quicker too, being
Much
able to
quicker.
catch
Yep.
those things. So as as somebody who kind of is looking at a big universe of managers, and also as somebody who was in the space for a long time, if an advisor is looking at global macro as a category and is evaluating opportunities, what are some of the key things they should be looking for or questions they should be asking so that they can better understand how to differentiate each manager from each other and what their potential value proposition or alpha opportunity might be when doing selection?
Well, I think it really comes down uh, to process, and so there's a wide range of different strategies that are out there, say in the macro space. Most of what you see is discretionary,
Mhm.
and so like I talked about in terms of even the very best discretionary managers. Some years they'll perform better than the index, and some years they'll perform worse. And so often by looking at proprietary managers, proprietary or discretionary managers, what you're adding is a lot of sort of noise around what is probably generally a pretty good return and a pretty good alpha opportunity, but it's noisy around that. And that's one of the challenges. And so if you see a strategy like that, you have to acknowledge that there are going to be times when you're going to have to be explaining away bad performance relative to anything. And there'll be times when you're going to benefit from it. Then we get our replication world where I think there is, factor based replication has really been, has been hot for a long time. Where I think one of the challenges there on factor based, meaning like carry, trend, concepts like that, they're big institutional asset managers that have products like this, is that those products, those smart betas or factors in the markets, sometimes they make money and sometimes they don't. And so that's, I think, one of the challenges is that um, that's not actually how hedge funds manage their portfolio. You don't go like, well, I'm just going to hold carry forever because that is, up and to the right, because there's sometimes when carry's good and sometimes when carry's bad. And so if you see a strategy like that, you have to acknowledge that there's going to be meaningful long periods of drawdowns related to the fact that those factors are not necessarily persistent. And then, the alternative option, which is what we're trying to do, is understand the positions in real time. Basically,
Mhm.
if you understand the positions in real time, then what you're doing is you're basically following how these managers are creating their positions, whether it is discretionary, whether it is systematic, whether it is pro some of the smart beta factors, whether it's against smart beta factors. Like all of those different things, that agility. And that's really what I'd emphasize is like, does your manager have agility, and do they have essentially diversification in the way that they're developing their strategy? Because if they have agility and diversification, they're much more likely to produce high quality returns over time than if they're sort of fixed in their decision making or very reliant on their own proprietary or discretionary views.
Yeah, the phrases you see in the hedge fund world is discretionary macro, systematic trend. That's typically like the things you'll see because there's always like the category and then the subcategory. So it might be macro, and then it will have a subcategory. It'll be like discretionary, systematic trend. And that differentiates kind of what you're talking about. Now, in the mutual fund ETF world, they don't do that. It's just macro everything. And I do think that more of the discretionary guys get thrown in tactical allocation, whereas like the more systematic folks get thrown into macro, but they're both doing something similar. So that is an important caveat. But yeah, to your point, understanding that. And I think a lot of people understand and know that there are some macro guys that got really famous because they got a couple of discretionary bets right. Like Soros is a great
Right.
example of that. And so just understanding like who you're dealing with, because if you're dealing with somebody who's doing a discretionary macro trend, you're really betting on the manager in the same way that if I'm evaluating a mutual fund of an active guy versus a passive, like Peter Lynch, Will Danoff, like I just have a belief that this is somebody that can outperform on a consistent basis, but also understanding that they're going to take bets that sometimes they're going to not get right. To your point of you get it wrong sometimes, but your overall belief is that more times than not they'll get it right, and that will generate alpha for you. So yeah, that's a good framework of which to kind of think of the space. And I would argue that you could probably pair those two things together to get a more holistic exposure to macro.
Yeah, I mean, yeah, when we talk to people, for instance, about our macro product, people say, "Well, is it discretionary or is it systematic?" And the answer is both. And I think um, sort of people outside the hedge fund industry often will draw relatively strict distinctions between those 2 points, meaning
Hmm.
what is discretionary, what is systematic. And the reality is that I think the most sophisticated macro managers think about that as a spectrum. And so some are often a little more on the discretionary side, and some are more on the systematic side. For instance, the my where I started my career
Hmm.
was more on the systematic side, but it's not black and white. And part of the story, the reason why it's never black and white, is because discretionary people are using, quantitative inference, let's just say, to develop their understanding and their views. It's not just like they walk in. No, no, there's no macro manager in the world that's like sitting at his desk, you know, looking out the window and being like, short the Brazilian real. Like it's just like
Yeah.
not how it works. They're looking at lots of quantitative information, and in some ways is systematic in the way that they're processing it, even if they're not literally systematic in their approach. And similarly, systematic managers will often, there's only so much you can systematize. Like part of the whole point of systemization is to capture most of what you can understand. But COVID happens, and like things are different in COVID than are
Hmm.
in your sample set, as a simple example. And so, having a little bit of the discretionary with the systematic is almost always the case. And so, what I like about looking at sort of all the managers is you kind of get the best of all worlds, which is you get the systematic people, the discretionary, all their sort of collective, you know, fighting with each other about trying to figure out what's going on. And what bubbles to the surface, that wisdom of the crowd, is actually pretty good over time. Is what you find, and more consistent than relying on any one of these different things. It's diversification of approach in addition to diversification of managers.
Yeah, I love that. I think that's a really good way to put it. Now, Unlimited Funds started obviously with your flagship that just hit its 3 year, but you've also recently launched some additional products. How have you found that your approach has been able to transfer to other products? And why are you excited to bring some additional products to market today?
Yeah, I mean, we've been lucky to be a startup issuer that's been around for 3 years. So many folks don't make it to this point.
Hmm.
And
Well, I think that's a testament to you. I really do
Well,
believe
I
that.
appreciate that. We launched our first product, HFND, which in a lot of ways you can kind of think about as like the SPY for hedge funds, meaning it's
Hmm.
meant to match institutional hedge fund returns, which, is, and it's a multi strategy product made up of replications of basically the six largest hedge fund styles. I think one of the challenges is that, most institutional allocators are looking for a cash plus or a bond plus type benchmark.
Hmm.
So while that strategy has basically done what it's supposed to be doing, and I think has been a great proof of concept showing that we can track how hedge fund managers are performing, I think, when we talked to advisors, they basically gave us 2 points of feedback. And this was great about the RIA, the ETF and RIA community. Is like we talk to advisors, people tell us, give us the input, and we can design products that actually help advisors with what they need and what they
Hmm.
want. Is they basically said two things. One, running at bond risk is too low in terms of it's not cash efficient enough for our
Hmm.
portfolio. We want something that's more like equity index risk. And we're like, great, we can do that. That's the beautiful thing about doing what we're doing. We understand the positions, we're exposing them in futures. It's just literally turn up the dials. Like how do you run essentially a 2x target return strategy? Well, we take the positions and we multiply them by 2. It's not that complicated. So that's really good. So we could deliver an equity like equity like risk profile.
Hmm.
And then the second thing they said is, don't necessarily give me all the strategies combined into one. Why don't you break out the individual strategies? Because like global macro, equity long, short, managed futures, fixed income, etc. Because every portfolio is slightly different. People have different needs. People have different gaps in their portfolio. Maybe you're looking for an active equity manager and you're not so happy with it. And so you want something like equity long, short. Or maybe you're looking for a true, all weather diversifier bucket as part of your 50-30, and that's where global macro fits in great. Or maybe you want something defensive that's a little more cash efficient with our 2x managed futures type strategy, right? That kind of gives you that managed futures, but reduces the line item risk. And so that was really great because we basically said, okay, so let's launch the individual strategies at a 2x, and it has been fantastic. I mean, we've been, of course, blessed with very strong performance across many of those strategies. But I think probably the thing that matters more to me is that I can see advisors with all sorts of different needs looking at this product suite, whether it's sort of conservative, just want a little diversification against 60/40, all the way to like building a total return profile strategy that has a low correlation to assets. We now, I feel like, have something for everybody, and it's working, and it makes for makes for very compelling conversations with the folks that we're talking to.
Awesome. Yeah, I love that. As somebody who builds out the portfolios, I like to have the pieces.
Right.
Because sometimes I find like a gem of a portfolio where I can't use it as my sole exposure to alts, but I want to build around it for one reason or another, and being able to have like the building blocks, I think, can be really interesting, and so I'm glad that you're doing that now. We're coming up on time. Is there anything I didn't ask you that you want to mention to our audience about what you're doing, or just anything you're working on? Where can they
Yeah.
find you? All that good stuff.
Yeah, I mean, when we started Unlimited, we talked a lot about our hedge fund approaches here, and I also spent some time in the venture capital side of the 2 and 20 business as well. Actually, after I left Bridgewater, and so when I think about Unlimited, I think about how do we bring low cost diversified 2 and 20 strategies to investors.
Mhm.
We started with hedge funds because that was a lot of our experience, but now, having built out, I think, a very compelling product set in the hedge fund space, we're now turning our attention to the rest of 2 and 20, and starting with something that we call liquid venture, which is a product that we're actively working on. The idea being, how can we give the everyday investor access to equity, real equity, in top quartile venture backed businesses, and do it without the 2 and 20 fees and the illiquidity that typically exists in traditional venture capital structures. And so stay tuned for that. That's the next thing that we're up to as part of our sort of broad goal of building what I like to say is the vanguard of 2 and 20. So
Yeah.
that's pretty exciting. If folks are interested in learning more about our products, unlimitedfunds.com. I guess it's here in the background. Or the ETF specifically are unlimitedetfs.com. And if you want to follow me on, I don't know, all the various socials, I'm under the Bobby Unlimited handle in most cases, or you can probably just Google my name. And I'm as famous as the Bob Elliott of Bob and Ray, the old time radio program. So I am on the front page of your Google search results, which is pretty exciting. So there you go.
Awesome. And we'll put all those links in the show notes as well so people can find you. I really appreciate having you on the show. It's not often that I have the opportunity to talk shop with somebody who shares my vision and my goals in terms of preaching the gospel of alternatives and why we're doing it, and like the incentives and the motivation behind it. Very rare. You're probably one of like two people on earth that share the vision that I do. So having you on the show is amazing. I really thank you for your time. For everybody else, I will put all of Bob's contact information in the show notes. You definitely want to follow him. He is not afraid to challenge the status quo and to say things controversial. That's something he and I have in common. So he's a good follow, and he'll be thought provoking and make you really think about things and challenge your knowledge of this space. And I think that's a good thing. Thank you so much for tuning into this episode. As always, don't forget to like this episode. Don't forget to subscribe to the podcast. Leave us a review. Put a comment down. Who do you want to hear from? What would you like to learn more about? We do pay attention, and we try to take that information and use it on future episodes. Appreciate your time. Until next time. The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Bonrian Capital Management's platform. As such, Bonrian may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Bonrian Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Bonrian Capital trademarks mentioned are owned by Bonrian Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.